Thanks a lot for that, Navneet. Dharmesh Kant, Head of Retail Research at Indian Nivesh Securities, is joining us on the show right now. Dharmesh, good morning. Let's talk about what you're advising clients right now. While we're talking about the mood of the markets, becoming slightly difficult to gauge the direction and the structure. So far, much of it has been digested. You are seeing that pick up, but it looks like the headwinds around 12,300 for the index seem to be kicking in more often. Do you feel that right now is probably a period where there could be further corrections from these levels?
Yeah, good morning, Devina. I think the market is, going to consolidate in a sideways kind of environment as far as headline indices are concerned. And the good part and the best part has been kudos to the Chinese, management and the government, because they have contained this entire virus epidemic into the China itself. It has not gone outside the borders, and all hats off to them for managing it in such a diligent and serious way. And I think this entails an opportunity for stock market investors and the equity investors to do the cherry picking while this consolidation is on. And that is precisely what we are advising our clients. So every decline in the market, we are using it as a buying opportunity. I don't see this market collapsing from here. Initially, when the outbreak was there, the views were different. But as it has progressed and how the things are happening, we do feel that this is a buying opportunity, and cyclicals are the space where we are focusing on. Primarily public sector banks, which have corrected again post their earnings announcement, and it gives you an opportunity to dabble out there and do some cherry picking. So Canara Bank, Bank of Baroda and SBI remains a hot and topic out there. At the same time, automobiles are looking attractive. Maruti is looking very attractive at current level, 6,800 kind of stock price looks pretty attractive, because see, Maruti is the only automobile manufacturer in the four-wheeler passenger segment space where for Q3 they have given a volume growth. So in a decelerating environment, they came out with a volume growth, followed it with a month of January again where there was a volume growth, and they are always coming out with new models which becomes a hit in the market. So that looks very attractive. On the two-wheeler space, Hero MotoCorp, again an entry segment vehicle manufacturer, looks very attractive with Rabi crop season. All estimates are that it will do a good crop season, and food inflation is high, which adds per capita income in the hands of people. Worldwide, we do think because of the halt in this economy, businesses will add to the consumer surplus in the hands of the consumers, the buyers. So corporate may take a profitability hit for the timing, but consumers will gain through this halt, and their savings will increase, which they will again do for buying activities. So to sum it up, it's a market where you have to buy the corrections and sit on your conviction.
What about companies which are not correcting, Dharmesh? Any thoughts on the likes of Avenue Supermarts or Trent, these two in particular?
Yeah, leaders, the valuations are beyond imagination. The type of price traction we have seen in Avenue Supermarts. And there's no justification as of now. Excel sheet you can always keep on 40%, 50% kind of a growth you can build in, but still again, if you look at the valuation, it goes far beyond. And the problem, I'm saying this as a problem, is because you have very few choices in the market to pick from, where you have a steady cash flow and a rising cash flow. So Avenue Supermart, all said and done, has been giving out numbers where the cash flow has been rising well. The other industry segment, it's not there. So there are ifs and buts in other segment, but these two businesses, Avenue Supermarts is the leader out there. Trent is just a rub-off effect of what Avenue Supermarts has been doing. So people are getting interested in that, and but I do feel that it's not a time for new investors or buyer to get into it. However, if you have been holding it, continue holding it. I don't see a price correction happening. At best, what can happen is a sideways kind of a consolidation coming in. For next 6 months, you don't see more than a 5% upside from the current levels of these stocks. Personally, I am not advising clients to enter into this space at all. However, there's Aditya Birla Fashions Retail, which again, it was a loss-making company, but I think as a turnaround has happened out there, and FY21 onwards, the profitability come in thick and fast. So the institutional sale, the impact which was there because of Aeroshirts not getting sold, so that they have overcome, and they have hyped off the franchises which were not profitable. So operating level, the company has turned around. So that looks attractive to me at current valuation. So it may be a doubler in next 2 or 3 years time frame. So I would be buying Aditya Birla Fashions rather than a Trent or an Avenue Supermarts.
All right. Aditya Birla Fashion, that's Dharmesh's pick. Dharmesh, stay with us. Lots more to talk to you about. But
I heard you mention that you're looking at cyclicals, Dharmesh. I want to talk about particular set of cyclicals and which metals and the names which have come out with the results. Nalco, do you track this fundamentally because the numbers just seem very, very disappointing?
Sorry, I don't track Nalco, as a company, but as far as metal companies are concerned, the results have been disappointing. Even Tata Steel numbers were not good. Even on the domestic market side, there was a disappointment when the numbers were played out. So I think fourth quarter is where you will see more of a traction coming in as far as numbers are concerned. But again, the type of fiscal situation is which the government is tied up. This all hope about cyclical recovery in metals may not play out in the domestic market. International is already a tough scenario out there. So it's a void. The space isn't as a void as of now.
Okay. The other one which came out with numbers, 2 names came out with results. I don't know which one you track, so I'm asking you both. One is Phoenix Mills, when the results were above estimates and the residential segment revenue went up 2.4 times. The other one is Chalet Hotels, wherein net profit itself expanded 2.3 times. Do you track either of these two fundamentally?
Yeah, Phoenix I do track, and they have a very good mix of annuity income as far as rentals are concerned and the property income. So that is a steady state kind of a business which they are on. And again, the valuation, I am not very comfortable with the valuation at which the stock price is trading. But in the present environment, it's a good buy. On the hotel business front, I think it's all Chalet Hotel or the others which are there in the business. It would be a short-lived kind of business because eventually the margins are going to come down and that will hit the profitability and the valuation at which Chalet Hotel is trading is again very expensive. So that's a word for me.
Z.
Dharmesh, come in on some of these auto, the auto components companies and the kind of results they came out with yesterday and the kind of flack they got. Bharat Forge, Motherson Sumi, and there is no excuse for what the stocks did yesterday. The numbers were bad. The point is, did you like what they said in the conference calls, and are you buying in the valuations here?
No, Neeraj, I am not buying into the valuations here because see, most of the auto component manufacturers have exposure to Europe and US, and the businesses out there are, the numbers itself is evidence of the fact that businesses are not doing well. So there's a downturn definitely happening for most of the auto manufacturers. Secondly, electric vehicle when it kicks in, so there will be many auto manufacturer components which will not be required when EV rolls out. So but that transition has to happen. That entails a capex and all sort of expenditure on their balance sheet will be there. So that shift one has to look very carefully. So be it Motherson Sumi or a Bharat Forge, the top 2 names out there, we are not buying any of them. I have my own apprehensions about their future outlook, at least for next 6 months.
And in fact, Morgan's, is a conviction idea from your stable.
I think, large cap names, maybe HDFC Bank or Reliance Industries looks attractive on corrections. Reliance Industries has already, entered a zone where one could start buying. So the fear about that GRMs will fall in the Q4 because of the lower offtake of crude and the crude prices falling off. So that is already being built in the numbers, the stock price. So that remains a good buy. And Maruti. So these are the 3 large cap names which we are liking at the moment. Other than that, it's all public sector play, be it SBI, Bank of Baroda and PNB. So these are high conviction trading and investing ideas from our side.
Okay. Well, one stock which is reacting to a price hike that they've undertaken is ITC. The stock's likely to start off higher. The first 6 minutes of the pre-open session set the price at about 3%. Is there value in the stock? One would argue Yes, if indeed you believe or your thesis suggests that the earnings are not likely to be volatile, you would presume that there is Dharmesh on ITC. Buy it because of the valuations or leave it alone?
See, the problem with ITC is if you look at the top line, so 44% comes from the cigarette division and the balance 56% from the other, be it paper industry, or agri, or FMCG, or hotel businesses. And now if you look at on the SOTP kind of a basis, the businesses separately. So FMCG business or hotel or paper division has not been earning the profits the way they should be, or the cash flow if you compare it with the peer-to-peer likes like FMCG. If you compare that with HUL, so the return ratios are pretty low. And when it comes to the PBT level, it is 83% is coming from the cigarette division itself, which is always a suspect given to regulatory, environment and the type of taxes which are levied in that. So, but that is the primary reason why, ITC as a stock has not been performing well, though the ROEs are in the 22-23 kind of return ratios they are giving. And now HUL, if you look at the ROEs are way above 70-80. So there is a clear disconnect between other businesses of ITC with a like-to-like comparison, and so it has been evaluative. You rightly pointed out, last 2 years it has not made money, and every time investors went in with a hope that things will turn around, but that's not happening. So there's some serious rethinking which needs to be done on the part of ITC management. I would leave it alone. If you want to play it out for a dividend pay or 10-15% kind of upside, given the price at which it is trading on, the trade is on. But if one is hoping for a 50-60% kind of a price upside in next 2 years, I have my own doubts out there. So as an investor, I would leave it. But as a trade, definitely the trade is on for next 10-15% kind of a move on ITC.
All right, Dharmesh, we'll let you go on that note. Thank you so much for joining us this morning. We're just minutes away from